That was man, we had quite quite the meeting there from Fed Chair Jerome Powell, quite the statement from the Federal Open Markets Committee, the FOMC, and quite the market reaction. It has been quite a day in the stock market. Welcome to Market Takes. I am Dion, Rabouin, reporter for the Wall Street Journal. We are going to dive into the FOMC statement, the Powell press conference. We are going to talk about everything Fed Chair Jerome Powell said, everything he didn't say, all the things in the summary of economic projections, everything we heard about the FOMC. Thank you all for tuning in to Market Takes. I know you could have been anywhere in the world, but you're here with me. We are not in the boss's office anymore. I got my own temporary office. We'll see how long this lasts, but thanks for tuning in. We're here at the Wall Street Journal headquarters down in Midtown Manhattan, and we are going to be digging through everything that was in this Fed report. We're going to talk about the FOMC decision as well as the market reaction, some standout points from that summary of economic projections. I think that was the big market mover today. We're also going to talk about the biggest takeaways from Powell's press conference, because I think that was after the summary of economic projections moved the market one way. I think Fed Chair Powell moved it the other way. We're going to talk about why that was and explain those moves. And we're going to talk about, what this does going forward, how what we heard from Powell and what we read from the FOMC statement changes the outlook for the market as we move forward. So we are going to dig into all of that starting right now. So the Fed raised rates 75 basis points, 3 times the rate they normally do, or 0.75 percentage point, as we like to say here at the Wall Street Journal. That was right on the numbers as expected. The Fed had really guided the market towards this reaction, and that report that we got on CPI last week, I think, had really moved the needle in favor of locking in this 75 basis point increase. The big change was the expectation for November and for December. And so we're going to talk about that a little bit more going forward, but expectations for for November now fully entrenched at 75 basis points, a 3 times the normal rate increase, and then another big increase in December is expected, about 50 basis points. We're going to talk about all of that. One thing I thought was very important from Fed Chair Jerome Powell, what he said during the press conference, he said we've just now moved into the very lower level of what might be restrictive territory, as in, the Fed said they wanted to get rates to restrictive territory. Well, Powell said we've just moved into the very lower level of that. And in my view and in the view of the committee, there may be a way to go, as in more rate hikes, higher interest rates, higher costs, more expensive to borrow, tighter monetary policy. Fed Chair Powell saying all of that could be to come. The immediate market reaction, that was a sell-off. We saw a sell-off in stocks. We saw bond yields jump higher immediately after the statement was released with the Fed's decision and the summary of economic projections. After that happened, the market kind of chilled out. You saw stocks actually sort of pick back up and actually go positive. The NASDAQ was even positive by over 1% as Fed Chair Powell was talking. Then we saw that reverse again. We're going to get into all that and why it happened. I'm going to explain that in a minute. The big thing that set the table for today was the August Consumer Price Index report, inflation. That really changed the market thinking from, okay, maybe we're going to get 50 basis points or 75. Maybe the Fed's going to slow down. Maybe they're going to say, okay, enough. We've started to set the table for slowing things down. And really, we got just the opposite, setting the table for rates to continue higher at a faster pace. And it was all about that August CPI report that changed market expectations. It changed Fed expectations. And I think that really set the table for what we heard from Chair Powell today and what we saw in the summary of economic projections and that Fed statement. So look, we did a live stream all about that last week, the day it happened on the 13th of September. Go check that out. You can watch that right now if you missed it. Check out what we were saying. We were talking about why that changed reactions, why that changed expectations. And you go watch that, you'll understand kind of how we got to where we are today. Anyway, looking past that, the big surprise, I think, is really that there's more to be done and that we are going to get likely, right? The Fed Chair Powell said, all right, we're not guaranteeing anything. We make decisions one meeting at a time, yada, yada, yada. But given that there's only 2 more meetings this year, and the Fed's summary of economic projections says that Fed individuals or folks on the Fed who make the decisions see rates higher by about 1 to 1.5%, well, the only way to get higher by 1 to 1.5% if you got 2 meetings is to raise rates by 1 to 1.5%. So that's what we saw in that summary of economic projections, and that's why you saw the market kind of immediately take that nosedive in terms of the stock market. Let's dig into that summary of economic projections a little bit, right? I want to talk about what we saw from the rate side, which was obviously that expectation for higher rates this year by December. And you get, like I said, 2 meetings left. But also, if we look at 2023 and 2024, the economic projections aren't really in line with a Fed that thinks there's a lot more work to do. What the summary of economic projections told us in very simple terms was the Fed thinks that they've done most of the work, or that most of the work will have been done by the end of 2022, and in 2023 maybe rates stay around where they are, but we're going to start to move lower because the economy is going to recover. We're not going to see a lot of job loss, and what we are going to see is inflation start to dramatically come down. That is very much not the tale that the August consumer price index or the consumer price index in August was telling. It was telling a very different tale than that. And so it's interesting to see the Fed's expectations for this upcoming year. They expect PCE is only going to rise 0.2 percentage points from their expectations in June. Again, the Fed predicting only 5.4% on CPI this year. That would be lower, much lower than where we are now. We're at about 6.5% on PCE. Only up 0.2% from where they predicted it to be in 2023. Powell reiterated we've got to keep at it, again invoking Fed Chair Paul Volcker, who whipped inflation in the 1980s, causing the U.S. that painful recession. Fed Chair Powell today again saying we're going to keep at it. I'm just like Volcker. That's my idol. That's my inspiration. That's who I'm going to be just like. But when you look through the summary of economic projections, well, if you're gonna whip inflation, that's likely to cause unemployment to pick up. You're likely to see higher unemployment than just 4%, 4.5%. You're likely to see with very high interest rates that stay high, unemployment picking up, GDP growth slowing down considerably, and that's not what we saw from the summary of economic projections. That tells us that the Fed expects inflation is still going to be transitory, that it's going to come down significantly and very fast, and that's what those summary of economic projections is telling us. This is a very optimistic set of expectations. It really is. It doesn't go by what we learned in August from that CPI report, and it suggests that the Fed really didn't see that August CPI report as a game changer the way a lot of folks in the market did. If you saw the bond market, if you saw, even the stock market, a significant reaction to that August CPI report, that seemed like a game changer. What we heard from the Federal Reserve today and Fed Chair Jerome Powell was essentially, we don't see that necessarily as a game changer. I want to talk about a note that actually came out a little bit after the summary of economic projections was released from Jefferies, Thomas Simons, and then Annetta Markowska. They're the economists over at Jefferies. Here's what they write, quote, "It is hard to believe that the Fed is capable of pulling off such a delicate landing of the economy onto a gradual glide path towards somewhat lower growth, only mildly higher unemployment, and on-target inflation." Again, I'm quoting here. "Nobel Prizes will be in order if this goal can be achieved while avoiding a recession." Basically, the folks at Jefferies, I'm going to translate that for you in case you don't speak economists, they're saying, we don't believe you, you need more people. In essence, the Fed is going to have to pull a rabbit out of its hat if it expects to actually deliver what is proposed in its summary of economic projections. That's big. You've got a lot of folks saying, I don't know. That's also what you saw from the bond market, and I'll get into that in just a moment. Big markdowns, though, in the summary of economic projections for GDP for this year, only expecting 0.2% growth for all of 2022. Now, that is a big write-down, and we know that the Fed tends to have a rosy outlook. They tend to have those rose-colored glasses on when they look at the economy, and 0.2 probably means 0 or lower, and if we have a 0 or negative growth for the year, it's going to be really hard no matter what the unemployment rate is to say that we are not in a recession. If you have 0% growth, really that's negative growth. The Atlanta Fed's GDP Now tracker just came out the other day showing that they're now projecting 0.3% for GDP in the third quarter. The third quarter was supposed to be the quarter that rescued us after we had those two back-to-back negative growth quarters in the first and second quarter. Third quarter GDP was supposed to be the thing that set it all up for a positive growth year. It looks like we're not going to have that, and the Fed is basically saying we're unlikely to have that. The other thing, unemployment, like I talked about, only expected to rise to 4.4% in 2023 and in 2024. If you're gonna raise rates and you're gonna keep them high, if you're willing to push the economy through a painful recession, unemployment's probably not gonna stay at 4.4%. That shows these very lofty expectations for the Fed, even though growth is expected to slow down, maybe not quite go negative, but slow down just enough. That's the kind of magic that these Jefferies economists are talking about that Nobel Prizes would be in order for if they can do that. The big message, I think, from the chairman at his press conference immediately following the release of the minutes, or I'm sorry, immediately following the release of the statement was, watch what I say. Listen to me. Don't worry about what I wrote in that summary over there. Don't worry about that. Listen to me. Inflation's still our number one priority. Inflation, inflation, inflation. That's all we care about and we're worried about, and we're going to get it down no matter what. Fed Chair Powell really hammered that point home, but you have to understand that he is the guy who puts together the report. Now, the statement doesn't come out without the Fed Chair's blessing, so we can't look through that. We can't say, oh, okay, well, you said that you are committed to this, so, no matter what, that's what you're going to do. But that's what Fed Chair Powell is trying to tell us with this press conference. Any question that came in, he was like, listen, my priority number one, number two, number three, number four, number five is getting inflation down. And we think that can happen. We think we're going to do that. We think we are in very good position to do that. I also want to talk about a note I got this morning from Bank of America. The analyst, his real name is Thanos. This is Thanos Vamvakidis. He's the FX strategist at Bank of America, talking about maybe central banks are being too rosy in their expectations for inflation. Because as we know, this is all based on inflation. He says, quote, once inflation increases above 5%, it can take many years to bring it back to 2%. On average, remember, 2% is the Fed's goal or their target. On average, it takes more than 10 years. The median is also 10 years, going back through history. The shortest period in recorded history, as per B of A, was 3 years in the cases of Germany in 1992 and the Netherlands in 2001. However, Thanos cautions, in both cases, inflation was much lower than in most advanced economies today, just above 5%. Remember, we peaked out at 9.1% in June, came down to 8.5% in July, 8.3% in August. So we were still well above that. Assuming central banks, this is back to Thanos' statement, assuming central banks still want a soft landing, they will have to accept a much slower convergence of inflation back to the target if they actually have a choice, because inflation is still surprising to the upside, just like we saw in August. So look, that takes me to the market reaction, right? Folks with money on the line saw what the Fed said. Initially, when that statement came out, they sold. Get everything out of here. We want to get out of stocks, want to get out of bonds. You saw stock prices go down, bond prices go down, which meant yields went up. Everyone packed into the dollar, et cetera, et cetera. Then as Fed Chair Jerome Powell kept talking, they said, oh, okay, well, maybe this won't be so bad. We're going to buy. You saw the NASDAQ rise up more than 1%, the Dow and the S&P up near that 1%. Then after Powell kind of finished talking, got towards the end of his Q&A, stocks sold off again. And as I look out here at WSJ.com, we ended the day at the lowest points, I think, of the day. Yeah, lowest point of the day for all three major indexes. Dow down 1.7%, S&P down 1.7%, NASDAQ down 1.8%. So a big sell-off because at the end of the day, the market said, you know what, this is negative. There are worries that maybe the Fed isn't taking this seriously enough. There are worries that maybe they're taking it too seriously, being too aggressive. And really, when you get to that point, no one's happy. The Fed is likely to do a lot more this year, and I think that's what the market took to heart and why you saw the stock market just sell off into the end of the day, because at the end of the day, what matters for stocks is much more about tomorrow than it is next year. And going through the rest of this year, the Fed's projections are that it is going to keep its foot very firmly on that brake, tightening up policy, making it more expensive to borrow money, making it more expensive for businesses to grow, and making it harder for the economy to grow as a whole. And that's why we, I think, are seeing that sell-off in the stock market, and we're seeing those bond yields on the longer side, only on the longer side, tick higher, or tick lower, excuse me. You saw short-dated bond yields, 2, 3, and 5-year bond yields rise actually, and then you saw those longer-term bond yields, the 10 and the 30-year, coming down. That suggests that there are worries about continued higher inflation, but lower growth, aka potential recession. That's what the bond market is really telling us right now. We're seeing basically across the board everything else lower. Crypto, you're really seeing Ethereum taken on the face, on the chin, down more than 2%. The dollar is bid again, up more than 1% against the euro, up 1.3%. Moving even further towards past parity, to where the dollar is significantly stronger than the euro. You're getting about 1 to 98 the dollar euro trades. So that's where we are right now. Higher odds is what the bond market is telling us for inflation. More risk-off sentiment, more risk-off trading, dollar going higher, bond yields in the longer term coming down, stocks going down. And this could be a theme for a while because the Fed says they have more to do to rein in inflation, and they are going to act, and they're going to act strongly. So what do we need to watch out for going forward? PCE report, that's the Fed's favored measure of inflation. We know what CPI was in August. Now we're going to get PCE, and that could tell the Fed what to do because they didn't get that report going into this meeting. So we'll get that on September 30th. We will also get a report on consumer sentiment from the University of Michigan, that final report. We're going to see how much that CPI report affected consumer sentiment. When we get that final University of Michigan report, we will be right here on Market Takes, breaking all that down for you. So make sure that you tune in to that edition of Market Takes on September 30th. That's going to be big. I think that's going to be a big day for the market, and you'll want to be right here with me on YouTube. And look, that's going to do it. Thank you guys all so much for tuning in to Market Takes. I am Dion Rabouin, reporter for the Wall Street Journal. We will do this again next Friday, September 30th. We'll be here or be a... And I know you don't want to be that. So stick with me, tune in, and we'll be there on September 30th. I'll see you then.